Ever wondered how Wall Street insiders grow their wealth? Welcome to the intriguing world of strategic investing. In this exploration, we'll uncover 3 key strategies that corporate insiders use to expand their wealth. First, we'll explore the art of covered calls, a technique that combines stock ownership and option selling. Next, we'll delve into the power of dividend reinvestment programs, maximizing the magic of compounding. Finally, we'll spotlight the dogs of the Dow strategy, a method that targets undervalued blue-chip stocks. Let's delve into the world of Wall Street strategies, starting with covered calls. Scene script. First up, we have a strategy known as covered calls. Imagine this. You're a homeowner with a vacant room. You decide to rent it out to earn some extra cash. Now replace the house with stocks, and the rent with the premium from selling options. This, in essence, is the covered calls strategy. Let's break it down. Every stock owner has the right to sell options on their stocks. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell a stock at a specified price known as the strike price before a certain date. When you, as the stock owner, sell a call option, you're essentially selling someone else the right to buy your stocks at the strike price. Now, why would anyone do that? The answer is simple: to earn income. When you sell a call option, you receive a premium. Think of it like rent money. This premium provides a steady stream of income, regardless of whether or not the option is exercised. Moreover, this strategy provides a level of protection against stock price falls. If your stock's price drops, the premium you received helps offset the loss. Remember, you get to keep the premium no matter what happens. But what if the stock price increases? Well, you stand to make a profit up to the strike price. If the stock's price goes beyond the strike price, the option will likely be exercised, meaning you'll sell your stock at the strike price. But don't forget, you still keep the premium. The beauty of the covered calls strategy is that it allows you to profit even if stock prices don't rise. It's a way of making your stocks work harder for you, generating income in all market conditions. However, like all investment strategies, covered calls come with risks. There's the potential to miss out on significant gains if the stock's price shoots up beyond the strike price, and you've sold your right to benefit from that increase. So that's covered calls, a strategy that can provide income and some protection against price falls. Now, before we move forward to the next strategy, don't forget to like, subscribe, and share this video. Leave a comment below, and we will make sure to answer any questions you may have. Thanks. Now back to the strategies. Next on the list is a strategy known as dividend reinvestment programs, or DRIPs. Now let's dive into this strategy a bit deeper. First off, what are dividends? Well, dividends are a portion of a company's earnings that are paid out to shareholders. It's like a thank you gift for investing in the company. Now imagine if you could use this gift to buy more shares of the company, and that's exactly what DRIPs allow you to do. DRIPs are programs that companies offer to their shareholders that allow them to reinvest their dividends back into the company, automatically buying more shares. This process happens without you having to lift a finger, making it a passive way to increase your holdings. But why would you want to reinvest your dividends? Well, the answer lies in the power of compounding. Let's say you have 100 shares of a company that pays $1 per share in dividends. That's $100 in dividends. Now, if you reinvest those dividends, you could buy, let's say, 2 more shares. So the next time the company pays dividends, you won't get dividends on just 100 shares, but 102. And the cycle continues. This might seem like a small increase, but over time, the power of compounding can lead to substantial growth in your investment. It's like rolling a snowball down a hill. It starts small, but as it rolls down and continues to pick up more snow, it gets bigger and bigger. This strategy also has the benefit of dollar cost averaging. Since you're buying shares at different points in time, you're reducing the impact of short-term price fluctuations. This can help to smooth out your investment returns over the long run. In conclusion, DRIPs are a powerful tool for investors looking to grow their wealth in a passive and consistent manner. It takes advantage of the power of compounding, dollar cost averaging, and automatic reinvestment to potentially generate significant returns over time. With DRIPs, your dividends aren't just a reward, they're a tool for growth. Last but not least, we have the dogs of the Dow strategy. Imagine being a dog lover, but instead of petting furry friends, you're hunting for high-yield stocks. That's the essence of the dogs of the Dow strategy. This approach is about finding the top 10 highest dividend-yielding stocks in the Dow Jones Industrial Average at the end of each year. and investing in them. So, how does it work? Well, the strategy is straightforward. You start by listing the 30 companies in the Dow Jones Industrial Average. Then you rank them based on their dividend yield from highest to lowest. You select the top 10, or the dogs, and invest an equal amount in each. These dogs are often the underdogs of the market, stocks that are undervalued. You're essentially betting on these underdogs to bounce back. Now, why would anyone want to do that? The answer is simple: the potential for higher returns. The dogs of the Dow strategy operates on the principle of mean reversion, the idea that stocks which have underperformed in the past have a higher probability of outperforming in the future. The high dividend yield indicates that these stocks are near their bottom and are likely to rise. But it's not just about the potential for price appreciation. The high yield also provides a steady stream of income. It's like having a loyal dog that fetches you a steady stream of bones, or in this case dividends, and that's not all. This strategy is easy to implement and requires minimal monitoring. It's a set-it-and-forget-it strategy, ideal for those who prefer a hands-off approach to investing. But remember, no strategy is foolproof. Like any investment strategy, the dogs of the Dow comes with its own set of risks. It's important to do your research and understand the potential pitfalls before you dive in. So, there you have it, the dogs of the Dow strategy, a simple yet powerful approach to finding value in the market. It's about betting on the underdogs, reaping the benefits of high yields, and potentially enjoying higher returns. Dogs of the Dow strategy, a simple approach to finding value in the market. Now that we've covered these three strategies, let's summarize. Firstly, we explored the covered call strategy. This is a smart move for steady yet conservative growth. You sell call options on stocks you already own, generating additional income. However, you must be prepared to sell your shares if the stock price rises above the strike price. However, you can buy back the options that you sold and keep the stock and sell the next month's expiration. This strategy is best suited for a stagnant or slightly bearish market. Next, we delved into dividend reinvestment programs, or DRIPs. These programs allow you to reinvest your dividends into more shares of the same stock, essentially compounding your investment over time. But remember, the success of this strategy is tied to the company's performance. So, choose wisely and diversify your portfolio. Two large companies that most people use their products every day that offer DRIP programs is Johnson & Johnson and Procter & Gamble. Finally, we discussed the dogs of the Dow strategy. This strategy involves investing in the 10 highest dividend-yielding stocks of the Dow Jones Industrial Average at the beginning of each year. It's a simple yet effective strategy for long-term growth. However, it's worth noting that past performance is not a guarantee of future results, and this strategy requires patience and a tolerance for risk. The dogs of the DOW for 2024 or Walgreens, Verizon, 3M, Dow Inc., IBM, Chevron, Amgen, Coca-Cola, Cisco System, Johnson & Johnson. Each of these strategies has its own advantages and potential pitfalls. It's crucial to understand your financial goals, risk tolerance, and investment horizon before implementing any strategy. Remember, knowledge is power. And with these strategies, you're well on your way to playing the Wall Street game. Now, armed with these strategies, you are ready to dive into the world of investment. Knowledge is power, and you've just been handed the keys to the kingdom. The strategies we've discussed today, covered calls, dividend reinvestment programs, and the dogs of the Dow, are not just concepts. They are tried and true methods that Wall Street insiders have been utilizing for years to grow their wealth. The beauty of these strategies is that they're not exclusive to the Wall Street elite. They are accessible to anyone willing to take the time to understand and apply them. So don't just sit on the sidelines, it's time to put your money to work. Remember, your investment journey is yours and yours alone. It's a marathon, not a sprint. Take your time, do your research, and make informed decisions. The world of investment is vast and full of opportunity. So get out there, make your move, and let the Wall Street game begin.